Okay. Kelly, thank you very much. This is Doug Conkel with Milliman. We're pleased to be here today. As we're kind of knee-deep in the holiday season, what better topic to talk about than retirement plan considerations for mergers and acquisitions? But we know there's no timetable for them. They can happen at any time, so it's always a timely topic. Kelly already introduced us briefly. As she said, we're all principals here at Milliman, located in Dallas, Texas. And today what we plan on covering with the attendees is listed there on this slide, the agenda. Basically, I'll cover some of the basics of the mergers and acquisitions just to kind of kick us off. And then we will transition into some pension plan topics with Bart Pushaw, who is an actuary. Then I'll come back and talk specifically about some of the defined contribution topics. And throughout that, Jenny Boggs from our compliance department will be here to add some color commentary. I know she has some case studies that she's seen over the recent years, as well as any technical questions that come up. So with that said, let's just get moving through the presentation. On the next page, so you can pick up a paper any day of the week and basically see, someone's bought someone, there's always some companies merging together or they're selling a group, there's always some activity out there. Across our client base, it really varies significantly. We have some clients that like to buy and sell, it seems like on a weekly, monthly basis, almost like they're trading cards. And then we have other clients that might have a merger or acquisition once every 3 or 4 years. But regardless of the frequency, kind of the process that you have to follow is the same. And so we're going to try to highlight that today as to what are some of the key elements of the process that you would want to follow to make sure that once the deal is done, you don't end up with any surprises. Before we move on to the next slide, I just kind of wanted to gauge the audience to see we have a polling question that should be coming up on your screens here to see the frequency at which you have mergers and acquisitions in your organization. So I'll give that a second. So you see the question up there. If you would just answer the question and we'll see what it shows. After coming off the election, this is kind of fun, huh? See if there's any ties. We need a recap now. Okay, so it looks like most of you typically buy, an entity, between 1 or 4 entities a year. And then I guess coming in second place, about 26% of you haven't had any acquisitions yet, but maybe it might be something on the horizon. And then the rest of you just kind of have a little bit of both, sometimes selling, sometimes buying. So thank you very much. That helps us kind of craft our presentation to the audience. So next slide, please. So again, kind of back to the basics. When you think about mergers and acquisitions, we kind of divide it into 4 key phases, if you will. If you're looking down at a 30,000-foot level, what do you need to be focused on if you're acquiring a company or if you're selling a company? And they're divided into due diligence, which may or may impact the structuring of the transaction, and both of those precede the actual closing, the actual transaction occurring. And then post-transaction, you'll have some transition and integration issues at that point in time with respect to retirement programs. Now, the key point of this slide is have a game plan before closing, because the key is if you get into closing and you haven't taken certain steps, then you're going to take some things off the table that might have been available to you. And we'll get into that a little bit more detail later, but it's very important that you do your due diligence early. Many of us at the table, we sign confidentiality agreements with our clients. We get pulled in, as these negotiations start. To do an in-depth review of the plans that are being acquired, again, to make sure that there's not any surprises. And I know over my career, there's been a number of situations where a client will call me up. It's usually an HR director saying, the M&A team just walked by and told me they acquired a client last week. And that's, it's a little too late at that point in time. Some options are off of the table. You might be stuck with the plan that might have been better off terminating it. The other comment I'll make on this slide too is the parties that you typically want to bring to the table when you have an M&A situation. I mean, obviously the buyer and the seller, the HR group, the finance group, You'll want to have your benefits attorneys involved with this one. If there's a pension plan involved, you want to get your actuary involved, and then get your record keepers involved. So there's a lot of people that need to be involved, but it kind of takes that many people to effectively review the whole situation to make sure that you're overturning any rocks that need to be overturned. The next comment here on the benefits impacted really is just, we're here to focus on retirement programs, but just keep in mind that it goes beyond that. If you have non-qualified plans, they're going to be impacted as well. If you have pension plans and health and welfare plans, they're going to be impacted as well, so you'll need to take a look at all that. Some of the key things that you need to think about as you're doing your due diligence down there is, what are we going to do with this plan? If we're acquiring a plan, are we going to terminate it? Are we going to merge it into ours? You'll want to take a look at the investments that might be in the defined contribution plan. Are they all liquid, or do they have a stable value fund that might require a 12-month put? How are we going to communicate this to the employees, and what action steps are we going to make them take? Are we going to make them re-enroll in our programs? Are we going to map their deferral elections over such that they don't have to make another election? What about their investments? How are they going to map over? What's the fiduciary liability associated with that? Unions add a whole new dimension to it as well, because now you have the collective bargaining agreements that you're going to have to be aware of and take those into consideration. Some other things to think about are called protected benefits. So whenever you acquire a plan, if it's going to, say, merge into your plan, there are certain provisions in the seller's plan that might have to be preserved that you can't get rid of. And so again, this is one of the reasons why you might want to have the record keepers involved, to make sure that that provision can be administered post-closing if it's going to merge into your plan, again, avoiding surprises down the road. So again, those are just a few things to consider. Jenny, did you have?
Yeah, I have a couple of comments on a couple of your bullet points, Doug, just to emphasize a couple of these that are really important. You did touch on, when talking about the investments, whether to map or not, the fiduciary considerations, and that's very important. Most of the 401k plans we see nowadays do have 404C protection, and they want to retain that 404C protection if one plan, the plan that's being, of the company that's being acquired, will merge into the plan of the company that's making the acquisition. So on the mapping of the investments, it would be very important to structure that mapping that it retains the 404C protection. So that would mean an advanced 30 to 60-day notice to participants, which, by the way, that period coincides with the blackout notice. So typically that's coupled with the blackout notice and rolled out in one communication piece. And if that is going to retain the fiduciary protection, we want to make sure that it describes the old and the new investments, and that the old and the new investments are reasonably similar to meet the DOL rules, and that it contains the appropriate comparative information between the old and the new funds. Also on, Doug mentioned that typically what we see, or what's usually a good idea, is to map the current 401k deferral elections of the participants. And that works out quite well. That normally means, though, that it's a type of automatic enrollment. So just consider that and give appropriate notifications, which, again, if structured right and given within the right time frame, can be coupled with the other notices that are required to be given, as well as just a layman's description to the participants of what's going to happen, which in some certain instances might also equate to combining that with the summary of material modifications, or SMM.
Okay, great. Thank you, Jenny. Appreciate that. On the next slide, so when you're talking mergers and acquisitions and the types of deals that are out there, there's really two main deals. You have asset deals and stock deals. An asset deal is really just as the name implies. That's where a company may come in and they're just looking to purchase the assets of another company or entity. They're not trying to buy the company completely out. After the transaction, the old company will still exist, and it will, have to shut down operations if all the assets were purchased. Sometimes only a portion of the company might be purchased. Typically during these deals, what we see, and I say typically because there's always variations to it, is a lot of times the acquiring company is doing this because they don't want the liabilities associated with the old company and its benefit programs. and a lot of times they'll ask the selling company to terminate their retirement plan before the closing date so that that plan can be shut down, and that, again, the acquiring company doesn't assume the liabilities of that program. But again, there's always variations to that. The purchase agreement could be written such that the plan will survive and would merge into the seller's plan. The next type of deal that we have out there is the stock deal. And again, this is where a company will come in and they will completely buy 100% of the stock of the target company. When this happens, I mean, you are the proud new parents of whatever retirement programs that the selling company owned at that point in time. Good or bad, you become the owner of it, so you're responsible for it. So if you remember earlier, I talked about those 4 key phases of the transition and the due diligence. This is extremely critical during a stock transaction because, again, since you're going to be responsible for the seller's plan, up to that point in time, you need to know that that plan is clean, that the documents are updated, that all the boxes are checked, because it will become your problem as the acquiring company. So that's an overview of the basics. I don't know, Jenny, if you had any other comments or if you covered them earlier.
Mostly I've covered them, but I do want to echo and emphasize what Doug had already mentioned, is that to the extent possible, get your retirement plan experts involved as early as reasonably possible, and recognizing, people like us recognize that we often have to sign a confidentiality agreement because we know about things that are happening before they happen. But just sit down with them. Your experts can help you come up with the appropriate steps to take, possible alternatives, and then together you can come up with a timeline and who's responsible for what. And also know that if for some reason, as Doug called it, you're the new proud parents of whatever plan you're assuming, you may be assuming some potential problems with a problem plan. And just, gain some comfort that that's not the end of the world, that both the DOL and the IRS have voluntary correction programs available, depending on what's wrong with the plan, that there are avenues that can be used to resolve those problems and get the blessing of the government.
Excellent point, Jen. Thanks. All right, well, that covers the basics. I think we'll move on now. We'll start to drill down into some of the specifics, and so I will, Bart, maybe you'd like to jump in here and talk about pension plans.
As always, thank you very much, Doug, and Ginny, too. Pension plans, defined benefit plans, though they're disappearing, they're not gone. And when it comes to deal making, deal structuring, pension plans can be add a little complexity to both the initial overview and reviews that your corporate teams might take in assessing, and really most of my comments will speak to the stock deals. Pension plans, too, because of the sometimes enormity of them, as they stand alone, even though on a corporate balance sheet they only show up as a net number, liabilities minus assets, those net numbers can change pretty drastically. And oftentimes, though we like to get involved, don't we all like to get involved in these deals as early as possible, all too many times, I know my experience, direct experience over the past 25 years or so, is sometimes we don't know about the deal until the ink is drying on the contract, on the deal page. But pension plans is one area especially where just a little bit of time invested early in the process can help assess whether a pension plan might be a deal killer or not because of the financial status of that pension plan. Oftentimes we get called in not knowing many or any details of the deal, just get asked to opine on some numbers, some valuation numbers from pension plans early in the deal, and then we don't hear about it for a month or 6 weeks or 6 months. And then all of a sudden later the deal gets more serious and gets closer to close perhaps, and then we get called back in to start planning, as Doug talks about, planning pre-close activity as well as what are we going to look like post-close. And then with pension plans too, there's quite a bit of subcategories of types of deals we deal with, we address, not only just stock, but even inside of stock. I remember during the 1990s, one of the kind of popular deal flows that we saw a lot of were these roll-ups where a financial buyer would come around and go around the country buying up sort of mom and pop, I remember steel fabrication operations around the country and roll them all up. And that's fairly simple to address. But then you get these others where we have a spin-off, a carve-out situation where you have maybe a large conglomerate that your company, your guys are on the buying side, and you're only buying maybe if it's nice, a nice clean division where it already has all of its own financials and all its own identity that you can look at and review and stop there. But a lot of times there's carve-outs where there are no standalone financials, and there might be even some push-down accounting from the parent or holding company, and you really just don't have much of a idea of what we're dealing with. And then, some of the surprises we face with pension plans certainly are things like recently concluded negotiations with the union for increases in benefits in the contract that are due over the next 3 years, the term of the contract. Change of control provisions inside of employment contracts or non-qualified plans. Remember one situation that happened where the owner, it was a closely held corporation, the primary owner had an employment contract where in a change of control situation, as defined in their contracts, the SERP benefit went up dramatically, but on top of the retirement benefit going up, which was kind of a pretty clear-cut deal, the situation happened where the change of control provisions triggered a gross up on taxes, and it literally tripled the value of what the company had to pay out dollar-wise because of all the taxes that would have gotten eaten up by the feds and state, and actually under 280G of the golden parachute rules would have taken a lot of that too. So big surprise. Other big surprises really don't see too much anymore. These retiree medical plans that don't have any plan documents, that you have locations, perhaps remote locations or plants, facilities that the local plant manager might have kind of verbally promised to the employee group out there, lifelong retiree medical benefits at no cost for you and your spouses, things like that. Poison pills or a similar kind of thing. And then one of the more recent and really more impactful surprises that we're dealing with on the pension side are PBGC. If you're not familiar with them, they're the sort of the FDIC of pension plans, and they have to take over a pension plan when a sponsor goes belly up in an underfunded plan. And so many plans out there now are underfunded that PBGC watches, and they're watching out for themselves and participants. They actually have people that look at newspapers and watch deal flow through the media and then start scouring data that they have available to them to see if those companies involved in those deal discussions have any underfunded plans. And if they do, you'll actually find that the PBGC comes knocking on your door and insert themselves into the deal. And when they do that, it usually means that they're going to want a lot of money carved out of that deal targeted for that pension plan going forward. A lot of surprises, a lot of experience, and as one message we'd like you to take away from this is I think as Jenny mentioned, is do get your advisors involved as early as you can, but also in deals, make sure that the people you get involved have some experience with these things. Okay, a few different breakdowns we'll talk about in pension plans. Certainly up at the header there, one of them I didn't mention is multi-employer plans. If your target company has employees in those kinds of retirement plans, it doesn't show up well on their 10K or their financial statement of the corporation, but they carry quite a ticking bomb that could go off, and it's something obviously that needs early identification and assessment, especially. Okay, so current state, of your target company, what's going on. One of the things that makes pensions different too is that they maintain their history. What do I mean by that? You look at the number of employees that you're talking about acquiring, and maybe it's 500 employee company that you're looking to acquire. You look at the health and welfare plan. Well, maybe it's got 500 or 700 participants once you got your spouses thrown in there and dependents. And you look at your 401k plan. Maybe you have 400 or maybe 600 participants in those things. Well, a pension plan, most of the time, maintains the historical path and evolution and even decline of a company, where maybe that company only has 500 employees today, but maybe they've downsized significantly over the past 10, 15 years, and they might have 5,000 participants in their pension plan. And 5,000 participants have a whole lot more liability and benefits due to them than what you might expect from if we're just dealing with 500. So trying to get the current state, what's going on with the current state of the target company, and compare it to your company, because one of the goals is going to say, okay, well, we're building a new company, we're acquiring somebody, especially if it's almost a merger of equals, where you're going to have to deal with the essence of keeping everybody happy, all your employees, all the new co-employees, all the deal makers that had certain assumptions built into the validation of why we're even making the deal, the so-called synergies that are always used as validation for making the deals. And usually it's up to us, especially after the deal is closed, to actually make those synergies, make those savings usually come to fruition. So find out what's going on. And oftentimes, a lot of the value that we can add in a due diligence project is simply offering you a comprehensive summary and review of all the retirement plans that exist at the target company in their provisions, and sometimes comparing them to what you have in your plans, what kind of demographics, what kind of plan provisions, because certainly we're not going to offer up front to, after the deal's closes, to pick the best of our pension plans or pick the best of our K plans or pick the best benefits offered under our health and medical plans. There's going to have to be some fine-tuning and some combining, and that's going to take a lot of time to sort through. And then compliance, if I go the right way, if I comply with this. Compliance issues, certainly with defined benefit plans, they're slow-moving animals. A lot of times you do want, as Doug suggested, to do something with the target company's pension plans before the close, because you simply have more options post-close than you do pre-close. And certainly with defined benefit plans, there's lots of, just like we have history with participation and headcount and liabilities, we also have a lot of history with maybe legal compliance or statutory compliance issues that we want to deal with. And then the last bullet on that page, I mentioned that the PBGC, they have sort of a almost all-encompassing kind of a regulation that's been dealt out fairly harshly with a lot of our clientele and plan sponsors with the 4062E, where if there's a shutdown because maybe you're buying one of the facilities, PBGC comes swooping in and has lots of authority and leeway and latitude to assess and grab a piece of the money out there and have it targeted towards the pension plan way above and beyond what anybody would have expected as far as cash flow going to a pension plan based on otherwise IRS-based minimum funding requirements.
Bart, I cannot let a compliance slide go by without making a couple of comments. So on the compliance slide that Bart has put up, there are a couple of things that I want to make a few comments on. One of the things that is always on our due diligence list when looking at the company's retirement plans, if you're considering acquiring a company, is are the plan's determination letters up to date? And that was always a very black and white process in the past, especially with individually designed plans, which our larger pension plans tend to be, is that on our checklist, we want the most recent determination letter, and then we, the experts, would take a look to see if that was up to date based on very concrete IRS rules of how often a plan had to be restated, that is updated for law changes, and then for a determination letter filing to make sure that the IRS has reviewed that plan and that it's up to snuff and that it has issued a favorable determination letter. And that was done in very set 5-year periods. Restatement cycles is what they're called. Well, most of you probably know by now that we found out from the IRS last year that they are eliminating its determination letter program beginning in 2017, so next month, for individually designed plans. And so what we're going to see is on that our checklist item for our due diligence, does the plan have a recent determination letter, and was it on time? Well, you know, with that program discontinued by the IRS, those determination letters that we're looking at over time are going to be older and older. Of course, we want to make sure that the last one the plan had was done on time, but, you know, beyond that, over time is all we're going to know 10 years from now when we take a look is that the determination letter from 10 years or more ago was compliant, it was done on time, but what we don't know is about any amendments that were done to the plan since that time, because those amendments typically will not have reliance on that old determination letter. So that's just one key point I wanted to make here. Another is one of the things that we always look at, and that's on our due diligence checklist, is were all the Form 5500s filed on time? And so, you know, let's say they're not. I mentioned a few minutes ago, both the IRS and the DOL have correction programs. The DOL does happen to have a voluntary filer, a delinquent filer voluntary compliance program for late Form 5500s. It's a lot cheaper if you get into that program and go in voluntarily versus the DOL discovering it later, in which they can impose penalties that are far beyond what they charge to go through the delinquent filer program. And, you know, generally what that would be is for each plan for a delinquent filing, it's only, and I say only because, you know, it's really a drop in the bucket when you're considering these, $10,000, or if a single plan is multiple years of delinquent filings, then there's a cap of $4,000. So it's a pretty easy fix.
Thanks, Jenny. And very much appreciate you jumping in and adding great value. Then on our next slide, for pension plans, funding and expense, one way to add value get value from your advisors, or if you have a pension plan, you know, our company, the buyer might have a different outlook on how to measure and report through financial reporting, maybe more conservative, maybe be more aggressive than the target company. And translating the target company's means of measuring benefit liabilities, especially on financial statements, you know, under GAAP accounting, really can vary quite dramatically between firms and between actuaries. So getting a translation of what will that pension plan look like on our financial statements can be very different than what you see just by looking at, for example, a 10K. And then trying to consider what the effect of the deal might be itself, considering that you might be looking to have a reduction in force either at the target company, your company, or both once closing occurs. And then, of course, there might be some lock-ins in the deal itself that say we can't touch benefits of the target company for 2 years or so, and getting some idea of what that's going to cost us above and beyond is important, as well as, okay, what happens when that window closes and the 2-year, you know, don't touch period expires, and what are we going to do, and what's the cost structure going to be, what's our fringe rates going to be based on that. Then funded status. This is one funded status where it can have a very large impact on the deal, how the deal is structured, and can sometimes, and has sometimes been deal killers, because the pension plan might be so underfunded, and the target company not being reasonable enough to adjust purchase price to account for that, it can stop a deal in its tracks pretty quickly. Another particular area where funded status is very important to a buying company is if that acquired company's pension plan is going to be brought over standalone. For example, it might be a union plan that you don't want to merge in and can't get rid of right away. So it comes over. If that plan falls into an at-risk funded status, which is generally around 70 to 80% funded, and if that comes into your control group, then that could very quickly have an effect that you don't want to tell the folks upstairs. What I mean by that is if the plan is deemed to be at risk under the IRS rules for funding, then that at-risk status freezes all non-qualified deferred comp throughout the entire control group. So all of a sudden, your folks up in the C-suites might have to be told that their own deferred comp plan is affected and basically almost shut down because of this maybe very tiny plan that we acquired in a relatively small deal on the other part of the country. So it's important to get those assessments because they can have an immediate effect on the operations of your plan going forward. And then optimal state going, here's where we get into post-merger integration and, what do we talk about, how we're going to look going forward. We're a new company maybe, again, especially in the case where we're mergers of equals. What do we want to look at like when we emerge from this deal? Are we going to change? We're going to take the opportunity here to implement any other kind of change throughout the organization since the deal tends to be a very big change in and of itself. Are we going to harmonize costs and we're going to stabilize? What's the effect on we don't have specific material here, but what's the effect going to be on our health and welfare spend if we bring in a group of employees from a relatively high cost region that we don't currently have populated now, like maybe the West Coast or the New England area, which has got much higher medical costs than, say, right here in Dallas or the South Central U.S. So there are a lot of considerations, obviously, and a lot of value experienced advisors can bring to you to help plan, because this planning for what we're going to be when we emerge doesn't have to wait, and usually doesn't wait until the close. It certainly takes an accelerated bit of energy after the close, but very high-level discussions and strategy are almost always begun well before close once the deal looks like it's going to actually happen. Jenny, any more comments before we ask Mr. Conkel here to pick up?
Yes, I do have just a few, and since Bart just covered pension plan specifics, I wanted to just cover a few of the required compliance steps that are involved when two or more pension plans merge. So one of the things on the checklist, and we normally put this at the top of our steps because it has to be done ahead of time, is that when two or more pension plans merge, there are IRS Form 5310A forms that have to be filed at least 30 days before the plans merge, and there's a separate Form 5310A required for each of the plans that are merging. And we do have situations we worked on in the plan where it's more than just one plan merging into another. So just remember each plan has that required filing. It's important to do the right legal documentation, get it all on paper when one plan merges into another. So that generally would entail a written merger transfer agreement and resolutions of each company that are involved in that plan merger to legally document the effective date of the merger and all the transactions that are going to go along with it. And also, there might be plan amendments that are going to be needed before one plan merges into the other. Benefits, rights, and features Doug mentioned, and there may be some other items that need to be documented via a plan amendment to the plan that will survive after the merger. Another thing to look at anytime more than one plan merges is what about qualified domestic relations orders or quadros of the plan that will merge into the surviving plan. Especially in pension plans, it may be years in the future before an alternate payee can start receiving the benefit payments, because generally under a defined benefit pension plan, the alternate payee cannot get their portion of the awarded payments until the participant's earliest retirement age. So just keep that in mind and make sure all the records are transferred over with respect to those quadros. One thing that some people don't think of in enough time, and then it's hurry up, is to let the plan trustee know. So these are normally, they have a corporate trustee is what we normally see, and the trustee needs to know, especially if money's going to move from one plan, the whole plan's trust into the other trust. So, but actually both trustees need to know. The plan that will not survive, their trustee certainly needs to know, and they need to know that what time frame all that needs to happen. And then the trustee of the surviving plan will need to know when to expect the assets, the monies to come over. As far as the transferred participants, the ones that will end up in the surviving plan that are coming out of the plan that will not be surviving, remember that there is an SPD requirement. So those participants that will be new participants in the surviving plan will need to get that SPD within the legal time frame. So that's going to be at least 90 days after the effective date of the merger. For the plan that will not survive, normally, you know, there is an annual funding notice requirement for plans that are subject to PBGC. So for the plan that will not survive, there is no annual funding notice requirement for the year of the merger, and that notice would normally be due by April 30th of the following year. But what will have to happen is that the plan that will survive, its annual funding notice, will need to contain some information about the merger, the effective date of the merger, and the identity of each plan involved in the merger. And last but not least, as you know, each year a plan would need to do an IRS Form 8955-SSA reporting for deferred vested participants. So the plan that will not survive on its final Form 8955-SSA will need to appropriately use the codes that indicate that those deferred vested participants no longer are entitled to those deferred vested benefits from that plan. But the plan that will survive on its Form 8955-SSA for the year of the merger will then report those deferred vested participants with the appropriate code to let the government know that they are due those deferred vested benefits in the future.
Great. Excellent, ma'am. Thank you very much. I appreciate that. And I'm sure our audience does too. Doug, you ready to pick up on
Yeah, you'll just advance the slides there a couple. We'll jump right in and start talking about some defined contribution specifics. So, you know, again, our first slide, if we haven't made this obvious so far today, due diligence is key here. We want you to get things rolling early. You know, a few other things that you need to pay attention to during this process is you want to look at the governance of the target company, okay? Did they have a retirement committee? Were they meeting? Do they have meeting minutes? Were they having audits? Is all that getting published? I mean, that's, you got a lot of lawsuits out there these days about excess fees and stuff like that in 401k and defined contribution plans. And, you know, if it's a stock purchase plan, you're going to inherit those liabilities. So you want to make sure that that was, you know, covered, that they were following the process to hopefully limit your risk there. Look at the communication materials that were put out, required notices, 5500s, all that stuff is very important during the due diligence process. But when you have an acquisition like this that goes on, typically you have one of four scenarios that's going to play out, okay? And we'll break it into these components. The first one there is either the seller's plan is going to be maintained, or the seller's plan is going to be terminated, or third, the seller's plan would merge into the buyer's plan, and then fourth, it could be one or the other of all these. It might just involve a group. It might not involve the acquisition of a whole company, just a partial group. So we'll talk about each one of these in a little bit more detail because they're all a little bit different. They each have different kind of pros and cons and things that you need to be aware of. So the first one we're going to talk about is the seller's plan is maintained. Now, a lot of times what we see in these deals, you know, if the plan makes it past closing, they didn't terminate it, and it's going to be maintained, eventually it will merge into the successor or the acquiring company's plan at some point in time, but not necessarily immediately. There's a lot of other things that are on fire that need to take place and get taken care of. A lot of times the benefits programs don't make it to the top of the list. And so they'll come out of the closing, and then, you know, the owner will have multiple plans covering different groups of employees, and they'll maintain those plans separately side by side. Now you can do this. An employer that's a control group can have more than one program, more than one retirement plan covering different groups of employees, but they would have to, on an annual basis, pass some compliance testing showing that these two plans are not being discriminatory. And without getting into the weeds, what they're basically trying to say there is they don't want one plan that, say, is covering a large group of highly compensated employees at a higher benefit as compared to a second plan that might be covering mostly non-highly employees at a lower benefit. They would consider that discriminatory. Now, the IRS, though, is in all their wisdom, has given us a grace period that when you come out of a merger and acquisition, they know it's going to be hard to meet that rule on day one. So they say plans don't have to pass that, or companies don't have to pass that compliance requirement during a grace period, which means once you come out, once the date of close of the sale, you have until the year following the year of that date of sale before you actually have to start doing that compliance testing. So what we see most companies do when the plan is maintained, they come out of the closing, they maintain those plans through the grace period, and then sometime before the end of the grace period, again, which could be anywhere from 12 to 24 months, depending on when the transaction took place during the plan year, merge those plans together. But again, I've had a situation, I had one client, it was just politics at the company. They had these two groups, they really couldn't come to terms. They had these two separate plans. They both liked the investment options they had in their respective plans. They didn't want to budge on the benefits. And so I had a client come to me and said, please help us. Can we just keep them separate for now, because now's not the time, for this to be a challenge for us. And we looked at it and we did the testing. We said yes, and they actually kept those plans separate for about 3 or 4 years before they merged them together. And as long as you keep passing that testing, you could keep them separate for as long as you wanted to. The Bart, you're there? Oh, okay. The next scenario is that you would terminate the plan. So again, we said a lot of times in the asset deals, you'll see this where the plan will get terminated. What is the impact going to be on participants if the plan is terminated? So when you terminate a plan, the participants have to take a distribution from that plan. They could take that distribution as a lump sum. They could roll it over to an IRA, or they could have the choice of taking that distribution and rolling it into their successor plan, their new employer usually. Usually when the plan's terminated, the employees go to work for the new employer. And the one thing to be cognizant of here is if you have a plan that you're going to terminate, take a look at the number of loans that are outstanding. This is where we typically see this come into play. If you have a lot of participants who have outstanding loans and you're going to terminate the plan, those participant loans are going to become taxable to those participants at that point in time. And while from a PR perspective, that's not a very good way. You just acquired them, they're just new employees, and it's not a very good message to send to them that you're going to take this tax hit. So what we've seen a lot of clients do when they terminate the plan is work with the record keepers involved to see if they can roll the loans over to the successor plan in addition to the account balances being rolled over. Now, not all record keepers will do this. You need to make sure that your plan documents allow for it, but if everything falls in line, the participants could elect to roll over into the successor plan.
I wasn't it either.
Oh, good. Into the successor plan, and then their loan payments would continue so they wouldn't default on the loan. Keep in mind when a plan is terminated that you do have the final 5,500 in audits that need to be adhered to. Also, the point in there is about forfeitures. If you terminate the plan, forfeitures will have to go to zero. They can be allocated to participants, but keep in mind a lot of plan documents allow forfeitures to be used to pay for plan expenses. And if that's the case, terminating the plan can be pretty expensive. So the selling company might want to use some of those forfeitures to cover some of the expenses of shutting down that plan. And that way they don't have to write a check for it. That way there doesn't have to be a large expense charged to the participant accounts. It's just something to keep in mind.
Yeah, and I want to make one comment about usage of the forfeitures to pay fees, and just actually generally payment of plan termination fees in general is just be careful, because the DOL does have rules on payment of fees from the plan. and make sure that the IRS basically says that the function of terminating the plan is what they call a settle-or decision. In other words, it's a decision of the employer to benefit the employer in the DOL's view. So anything related to that settle-or decision, anything to benefit the employer, is not payable from the plan assets. But anything on the administrative side to get the plan shut down, anything to get it through the functions, to pay out the balances, to find lost participants, that can be paid from plan assets. Maybe the IRS has there are law changes that the IRS would require the plan to be amended for before the time it terminates. Even if for some reason that required plan amendment wouldn't be sometime in the future, the plan termination does accelerate the time when that amendment has to be adopted. So because that is an IRS required amendment, that can be paid out of plan assets. Anything to keep the plan qualified can be paid out of plan assets. But let's say that there would be some plan amendments or such to implement the employer's decision to terminate the plan. That's a settle-or expense that cannot be paid out of plan assets. So those different types of functions need to be placed in a settle-or category and an administrative category, and some of those expenses possibly can be paid out of the forfeitures to use them up, some not.
Okay, great. Thank you, Jenny, for that clarification. All right, so let's move on to the next slide. The third scenario you might have is again, just merging the plans together. And, you know, again, this you need to bring the record keepers together because there could be some timing considerations here. You've got to keep in mind the contracts that are in place. If you're going to merge the plans together, obviously you're going to tell one record keeper they're losing a plan. You're going to tell another record keeper they're gaining a plan. And there might be contracts in place. You might have to give a 90 or 120 day notice possibly to the record keeper losing the business. Record keepers have implementation schedules, so that you can't just toss out a date necessarily and say we want it on this date. They kind of have to work it into their schedule. So again, this is a reason to kind of be in front of this and plan this out. The nice thing about merging the plans together with respect to the loans I talked about earlier is that they're just going to continue. The participants can just continue to repay their loans in the merged plan, so there's not an impact on them. We've already talked about mapping the investments and maintaining the 404C protection out there, but again, you're going to want to take a look at the investments in the selling plan and make sure that they're liquid. Some stable value funds out there will require a 12-month put, and that could put a wrinkle in your plans. Protected benefits, again, this is another area that you have to take a look at. There could be some withdrawals or other provisions in the seller's plan that you have to maintain. And it's good to know ahead of time to make sure that the record keeper who's going to be assuming that administration is going to be able to accommodate those provisions. Another point we'll make here when you merge them together, again, is the forfeitures. Now, in this case, the forfeitures don't have to be distributed. They don't go to zero. And so, when you're looking at your target company, I mean, although this may not be a lot of dollars relative to the whole deal that's going down, sometimes those forfeiture accounts can be fairly significant, and you as the acquiring employer, those forfeitures are going to become available to use for qualified plan purposes. And again, they could help defray some of the expenses of the merger with the same caveats that Jenny made earlier about the settler expenses and everything, but it's just something to be aware of. And then the last point there too is when you do merge a plan in, obviously the plan that goes away does have to file that final 5500 and everything, and they'll have to continue to do audits and everything else like that. So.
Yeah, and just a couple of items on Doug's slide about if the plan is merged. We already discussed typically what we see and what works well is to map over the investments and map over the deferral elections. That is a form of automatic enrollment, bringing their prior deferral forward. But there might be some other elections and designations that we often put in the merger or transfer agreement to document other elections or designations that are going to come into the plan, the surviving plan. There might be, for example, beneficiary designations. That's a good one. Oftentimes, we bring those prior designations over and they survive, and we don't make the participants who are transferred put in a new beneficiary designation. Another one might be, another thing to look out for, and this one isn't as big an issue in defined contribution plans as I talked about at the end of the pension plan discussion, but these defined contribution quadros, there may be some. What we normally see in a DC plan is that the alternate payee can get paid out immediately once the order is determined to be a qualified order. But there may be some quadros that have been lingering a while, and you want to make sure that you get all those quadros and all the records for those from the plan that is not surviving so that no alternate payee payments are overlooked. Make sure you ask for all of the quadro records as well.
Okay. All right, thank you, Jenny. So just the last slide that we have up there is just a spinoff. You know, a lot of this discussion has been about kind of acquiring a whole entity or company. That's not always the case. Sometimes you just buy an operating division or unit or a location. And so after that transaction, the selling company's still going to exist. They're still going to have a plan that covers the employees that remain with them. And so you might just be talking about terminating a segment of their population, making them eligible to do rollovers into the successor plan. We've also seen agreements where possibly the group that sold, they would spin off a portion of that plan and it would merge into the successor employer's plan. So kind of the same things that we talked about apply to the group as well, but now it's just a smaller group. It's only a portion of the company. I think that kind of wraps up our prepared comments that we have here. Moderator, do you have any questions that have come in?
No, we don't have any questions yet. Ladies and gentlemen, I encourage you to use the question and answers pane at the bottom of your screen. Go ahead and type in any questions you have for our speakers, and they'll see those and answer them as time allows.
Okay. You know, we talked about during the due diligence process uncovering things. I mean, some of the situations we come up with, we found clients who on their 401k plans weren't doing annual discrimination testing. And so we had to go back and do testing for multiple years and do corrections. We've had an employer where they weren't using the right compensation for the plan as well. And so we had to go back and calculate QNEX to the plan where the employer actually had to fund some dollars into the plan. So, you know, with these things, you know, they're not on, they have price tags associated with them. And as Bart indicated, you know, on the pension plan, some of those price tags definitely can be large enough to where it might impact the deal or even cancel the deal. So some of this stuff can be pretty large. Any other comments? You seen any other?
Well, I mean, one of the things you often have to look at, whether, in going back to the defined contribution plan side, the plan that is being acquired, regardless of whether it terminates or whether it's merged in, it typically doesn't happen on the last day of a plan year. So there is going to be some short period issues. For example, final short year testing. You know, you normally need to take a look and do prorated compensation limit, prorated 415 limits. Another thing to look at, we're seeing a lot more safe harbor 401k plans nowadays. There are certain requirements for a safe harbor plan if it doesn't exist for a full 12 months in its final year. So just know that if you're ceasing that safe harbor contribution, even if that's whether by merger or plan termination, that there's an advanced 30-day supplemental notice that needs to be given to the participants so that they know that that's going to happen. Usually under the safe harbor rules, if the safe harbor contributions cease mid-year, so to speak, there is final year ADP and ACP testing, even though it's a safe harbor plan, and that has to be for the entire however many months are in that final short year. There is an exception, however, in the case of you know, mergers and acquisitions of companies, so there would be an exception to that final short year testing for a safe harbor plan.
Okay. All right. Excellent points, Jenny. Do we have any questions on the board yet, or should we give everybody a few minutes back in their afternoon?
Well, we did get one. Do you recommend retaining the audit firm that the terminating plan had prior to the acquisition transaction that is for that plan's final audit?
It usually works best if that is the case, because that auditor normally has done the audit for years. They normally know the plan, they have the notes, the records, et cetera. If we bring in a new audit firm, they're getting up to speed. They may have to retest some of the prior plan year's information from the prior auditors. It may slow down the process. You may get into a situation if you switch auditors that you're running up against the extended deadline and the audit is still not done. So, you know, each situation is different, and there may be reasons why the acquiring company may want to use its own audit firm, but it normally causes problems. And sometimes we see that you miss the extended deadline and have to file under the delinquent filer program.
Thanks, Jenny. Kelly, anything else?
Looks like we've got another one that has just come in. In the example where the acquired company allowed the multiple plans for longer than the IRS grace period, was there additional or different requirements and timeframes for the new, quote, termination, end quote, of the plan?
Oh, you gave your example of your company that went 3 or 4 years.
For the terminate, I mean, basically once they passed the grace period, they just, every year they just had to do this additional testing to show that they could be maintained separate. And then they did that for about 3 or 4 years, and then they chose a point in time where they wanted to merge the plans together. You know, since both of these plans were basically under common control with that owner, they couldn't terminate one. Then their only choice at that time was to merge them together. That was kind of the point we were trying to make, you know, up front, is that a lot of times during these decisions, before closing, you have to make the decision if you're going to terminate the plan, because if you don't terminate the plan before closing, you may be stuck with it to where you either have to maintain the plan or you have to merge it in, but you won't be able to terminate it at a later date.
Yeah.
Yeah, and part of the nuance of the difference is terminating sort of closes the closet door on all those skeletons that might be living at that old plan.
Yeah, you have to be really careful in a stock acquisition to deal with that acquired company's plan before the deal goes through.
Okay, good question. Thank you.
Okay, well, I think that looks like all the questions we received so far. Thank you all for the excellent information and taking the time to present this to our audience and answer all their questions. We're thrilled to welcome Milliman to Chicago and Austin next year in 2017. So I hope that some of you in the audience will join us and register for one of the conferences next year. And be sure to check out our website for future webinars. Again, thank you, Bart, Doug.
That sounds great.
Jenny. We really appreciate it. And
thank you, everybody.
Everyone has a great afternoon.
All right. Thank you.
All right. Bye-bye.